Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Netflix came out with their earnings. Are you a big Netflix watcher? What do you like?
You know, I dabble in Netflix.
Okay.
I do. I have the the cheapest version of Netflix. With ads.
So you get the ads.
Yeah, I get the ads, which I probably should just pay up because I think it's like a $2 a month difference, but like I'm a little chintzy on that. But I do watch the Dallas Cowboy Cheerleaders Netflix show.
Oh, wow.
I think it's really well done. So I don't watch a ton of Netflix, but I do. I think I bought the Netflix subscription to specifically watch that.
Yeah, well, that's what a lot of people, I don't know. I haven't gotten into the Squid Games. That's huge for them.
Right.
Stranger Things, a little bit I dabbled in. But the thing is, overall, they had some impressive results, right? But the problem I'm having this morning is shares are low. We have Netflix down nearly 5%. What is going on here to explain it all for us is Geetha Ranganathan. She's Bloomberg Intelligence Analyst on U.S. media. Geetha, thanks. Always a pleasure having you here because you break it down like nobody else does. So talk to us why those Netflix shares are lower this morning.
Yeah, so what I would say, Lisa and Emily, is results were definitely solid. I mean, we had a solid second quarter print, whether it was second quarter results, whether it was, third quarter guidance, everything came in above expectations. They even raised guidance for the full year, both for revenue growth as well as for operating margin. But I think what we're really seeing, and kind of the muted reaction in the shares today is really because expectations going into the quarter were extremely elevated. And while I say that the quarter was solid, it probably was not exceptional. And I think that is what investors were really hoping for, and you really needed for, the stock price to go even higher. So at this point, valuations really, really high for Netflix, trading at about 45 to 50 times forward earnings. So obviously you needed some huge catalysts, which we have fundamentals that are really, really strong. But if you have that one big thing, Netflix didn't necessarily have that this latest earnings report.
What did we learn in the earnings just about what at least Netflix is thinking about for the next leg of growth? Are they planning more content? Is it more about focusing on live events?
Yeah, it's a little bit of everything, actually. So just if you look for the near term in terms of the next leg of growth, so we're just looking at the next 6 months or so, they actually have a massive monster slate. And they characterize this as one of their best 6-month periods ever. You mentioned Stranger Things. You talked about Squid Game. You have Wednesday. You have a whole bunch of other, live events, including the NFL. You have some boxing matches. So they really have it all coming up. Not just the 6-month period. The upcoming 6-month period is, of course, going to be extraordinarily strong. But then even into 2026, I mean, management was talking about how they have really this excellent standout content lineup. So content is obviously going to be a very, very big thing for them. But as we kind of look out, every year has its own special, catalyst. So in 2024, for instance, it was subscriber growth. It was all about subscriber growth. And you had, this password crackdown initiative. You had the new advertising tier that pulled in over 40 million new subscribers just in that 1 year. Then for this year, 2025, it's really all about price increases, right? So they already raised prices. We're talking about 16 to 20% price increases across most markets, and they're going to continue to raise prices. A lot of it on the back of that content slate, that monster content slate. But then really, as we kind of look forward to 2026, the big catalyst, and I think the big market mover for Netflix will be its advertising business. So we've kind of seen them, dabble a little bit in advertising. They've been a little bit late to the game, I would say, in advertising. This was a pure subscription service, but they've gotten, I think, most of the pieces ready for that business to take off in a big way. They said that their upfront sales so far has been pretty encouraging, and you're absolutely right in terms of the live piece of the puzzle there, because they really need to have a very good live event strategy in order to attract all of those top global brands and top advertisers. And I think they're doing exactly that. And so next year we're going to see advertising. I mean, it's so far it's doing still pretty well. They've said that they're on track to double their advertising revenue for 2025, but I think it's going to take off in a really, really big way next year. And then by 2020, in another few years' time, I mean, expect this to be about 10 to 15% of their total revenue. So it is going to become a big portion of their growth story going forward.
Yeah, I love the live events, like the boxing match, Amanda Serrano. I was all over that. It was a good one. So you mentioned these prices. So how much can Netflix continue to raise their prices for subscribers? I mean, before they start to tune out, before Emily Graffeo shuts it off.
I actually think they have very good pricing power. And a lot of that, of course, is going to be based off of the content. And they're obviously continuously investing in the content, in a disciplined way, but they're definitely broadening it. They're deepening it. And the content definitely has huge appeal. I mean, we've seen this, time and time again when they put out all of their engagement reports. You have every Netflix subscriber watching, the Netflix content for an average of about at least 2 hours a day. So that's definitely pretty strong. So they're going to continue to keep adding to that content in terms of, live events, in terms of other things. And, I think that is definitely going to be a big growth catalyst for them.
Just very quickly in the last 30 seconds here, Geetha, talk about their competition right now, because there are a ton of streaming services, but obviously, I mean, Netflix is up about 90% over the last year. Did this earnings result show us that they're still the clear leader in streaming?
Yeah, they are the undisputed leader. I mean, there's absolutely no doubt about this. They won the streaming wars. The only one other name that kind of keeps coming up in terms of, viewing time would be YouTube. But I think both of those platforms are very different. So Netflix really kind of specializes in premium content and scripted content and prestige dramas. YouTube is really more for kind of casual user-generated content. But again, the way that Netflix management has kind of framed this whole question about competition is that, they still have, if you kind of just look at the whole viewing time, Netflix and YouTube combined only have about a 20% share. So they're really 80% is still up for grabs. And the way that, Netflix is kind of characterizing that is there's still plenty of upside in terms of them kind of capturing more share. But you're absolutely right. They are way ahead of their competitors in terms of viewing share right now.
All right. Thank you very much, Geetha. Always glad to have your insight. That's Geetha Ranganathan, Bloomberg Intelligence Analyst on the U.S. media, keeping us all on top of Netflix earnings.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, welcome back to Bloomberg Intelligence Radio. I'm Emily Graffeo with Lisa Mateo. Paul Sweeney is out. We had a slew of earnings today and a good read on the consumer coming out of American Express. Shares were falling, but the credit card company's expenses were higher than expected. TD Cowen called the results neutral overall, noted that the earnings upside was driven by a lower than expected tax rate. We're going to have Paige Smith, Bloomberg Consumer Finance Reporter, break all of this down. Maybe we could start with how Amex is standing out from competitors right now. And what did the earnings overall show us? Because it does really feel like this is a crowded space here for like premium credit cards and premium consumer finance companies.
Certainly. Thanks for having me. I think the one thing that I would note is that Steve Squeri, who's the CEO of Amex, got a lot of questions on this morning on the analyst call. Just the idea that, of course, the premium space, folks who really love rewards on their credit cards, travel, hospitality, airport lounges, all of those nice things. It's a very crowded space, and it's getting more crowded, actually. Citi just announced earlier this week, for example, that they were actually re-entering the space after sort of taking a bit of a hiatus there. So it's certainly an area to watch, but Amex really asserted itself during this batch of earnings to basically say, listen, we are sort of the original premium card offer company here. And we're going to continue being the premium card offering for consumers in the U.S.
Now, they had record card member spending. So what does that say about the state of the consumer? They're continuing to swipe away.
Yes, that was another question that Steve fielded a couple of times on the earnings call. It essentially does say that folks in the premium space are continuing to swipe, tap, and spend in every preferred way. And yes, it's sort of all's well for the Amex consumer at this moment in time, certainly.
Did we learn anything about any specific updates to the Platinum card? Because people get so obsessed with the
people
love
the updates, and again, it was certainly asked, and no, we do not have any more updates for you just yet. We know again that the updates are coming in the fall, and we know that the competitive landscape is tight. But
are they going to raise the price?
I think it's safe to say that they're going to raise the price. That's me putting my spin on things, but if they didn't raise the price, it would be a pretty great deal. I'll put it that way. And I don't think the economics would really make sense for the card if they did not raise the price.
But I'm thinking, so if more people are taking advantage of all these perks, right? Because I know I do. Like if I'm tracking my points like crazy. So does that kind of mean that, you know what, the consumer is kind of cautious at the same time because we want to go for those deals?
That's a really good question.
Yeah.
I don't know if that's the case. I think that there are a lot of deals and rewards hounds out there like yourself who really just track it very closely. And there was a comment made on the call that it was something along the lines of, consumers really like these rewards and they track them very closely and they pay for value. So I wouldn't say it's maybe a warning sign. I would say it's more of a sign of like a savvy consumer per se.
Stable coins are very hot right now on Wall Street. Is that a threat to Amex's business?
Well, so it's certainly been the flavor of the week, if you will. Stablecoin, the word stablecoin has popped up in pretty much every earnings call I've tuned into over the last week, whether it's the big Wall Street banks or even Schwab mentioned earlier. Schwab reported earnings this morning as well. And, when it comes to Amex, they basically said they're very closely watching the technology to see how they can either issue their own stablecoin or partner on a stablecoin offering of some kind. They sort of hedged and said it's still early days relatively. But one thing was very clear, which is Steve Squeri came right out and said, is this a threat to existing payment rails? No, it is not. And that's kind of the same thing that we've been hearing kind of across the payments companies, whether it's from Visa or MasterCard, Amex, kind of the same tone there.
So are people paying off their Amex bill? I mean, how is credit card debt?
So an interesting stat actually that they highlighted in this round of earnings was that Gen Z, so Amex is making a pretty concerted push in the younger consumer space at the moment. And they highlighted that Gen Z and millennial spenders were paying, their delinquency rates or kind of being like 30 plus days past their bills, were actually lower than industry trends for older consumers. So you would think, younger people are just getting used to paying off credit cards and sort of learning about how to handle their debt. And there was kind of some question about Amex targeting these younger consumers with this like premium credit card that comes with fees. But they've basically countered and said, hey, so far so good. They're actually paying them off. The delinquency rates are quite low compared with the industry, definitely lower compared with the industry in their peer group, but even lower among older consumers. So kind of an interesting metric I thought that they highlighted this morning.
Well, that's some good news. If people pay their bill, you have to. Paige Smith, thank you so much for joining us here in the studio. She's Bloomberg Consumer Finance Reporter, talking about Amex and credit card debt and all of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Lisa Mateo alongside Emily Graffeo. You were listening to Bloomberg Intelligence. Paul Sweeney does have the day off. Okay, so 25-year-old trading powerhouse Jane Street in the glare of a global spotlight. At least that's according to Katherine Doherty. She's Bloomberg finance reporter. Her latest big take story. This one, a lot to dive into, but I want to start by setting the table. Like, who is Jane Street and what sets them apart from other firms out there?
So Jane Street has become one of the largest trading firms in the U.S. and really across the globe. They started out, their founders are from Susquehanna. That's another trading firm that they compete with today. But over the years, they have really developed their technology and their people to generate billions of dollars in revenue. They've grown so large that their trading revenue has surpassed some of the biggest U.S. banks. They're now larger in scale, at least the money that they're making, than Bank of America and Citigroup. So we're talking a lot of money, and they are really behind the scenes. So I like to think about them as they are responsible for the plumbing of the market and making sure that all of the trading is actually just moving through the system. They're handling orders from customers, not directly. Some of it is indirectly. If you have a retail broker, they're the ones that are receiving the order from their clients. That order gets sent to a firm like Jane Street, and Jane Street handles the actual execution to make sure that they're matching the buyer and the seller. They might take the order and then eventually they sell it off, but the middleman player, that's Jane Street. They're the reason that trading can continue. Them and their peers play a very important role in the market structure overall.
There is some regulatory scrutiny right now in India when it comes to Jane Street, which we're going to get to in a second. But you write in this big take that you wrote along with Bernard Goiter that they're famously secretive. Why are they so secretive on Wall Street?
Well, number one, they don't really have to say a lot. This is a private company. What they do doesn't require public interface at all. They're providing a service and they don't have to answer to shareholders. So many times they would like to operate in the dark in many ways. It doesn't necessarily mean what's going on behind the scenes and what's happening in the dark is nefarious at all. There's just not really a reason to say anything. But what they do is and who works for Jane Street is a very particular type of person. They have quants, they have mathematicians, and this is not unique to Jane Street. Other peers like Citadel Securities and Hudson River Trading, they also attract those types of people that go to these firms. But those are not the type of people that are in the business to speak out. And they're just doing their job because they're providing a service. And that service doesn't necessarily need words. It's a lot of really intricate, again, it's the analysis of just how the markets are moving, and they're trying to just be faster and better than their peers. It's all about competition. And they say all of the market makers like a Jane Street and a Citadel Securities would say that competition is a good thing, because if you are trying to be faster, that's going to be a good thing for their customers, because orders are going to be priced tighter. You're not going to lose as much money. And really the reason that the market has evolved in the age of electronic trading in the way that it has is because of these firms.
Now, Katherine, you're a pro. So is there anything that surprised you when you were doing this research for this story?
I would not say I'm a pro at all. Actually, I mean, the reason I enjoy the reason I enjoy reporting on firms like this is I'm learning so much. Sure. And the people that work in the markets, covering market structure here at Bloomberg, I am fascinated by just how niche and how nerdy it goes. So, I mean, I would say what surprised me in this reporting, what surprised everyone on Wall Street was when the numbers were starting to come out of how much money firms like Jane Street were making. It was to surpass the big U.S. banks in terms of trading revenue. That was incredibly surprising, and something that even competitors to Jane would look and say, how are they doing what they do on the scale that they do? And the answer to that in my reporting, and a lot of what this story is about, is the amount of risk that this firm is taking. Now, the reason that they can take so much risk, that's another element to it. It's not as if they're just throwing caution to the wind. They're doing this and they know exactly how much risk they're able to take. The reason they can stomach the risk is because of the capital that they're working with. That capital, the money that they are putting out there and they're, for lack of a better word, playing with, it's so large and it's all theirs. So if you are a hedge fund, as comparison, that money, you have to answer to shareholders. So if you're taking big risks and it doesn't work out, well, it's not just, oh, sucks for us, that it's really bad for your clients and your customers. Jane Street, that's their capital. So they might take bigger risks because they think there's going to be a bigger reward on the other side. And if it doesn't work out, it's not as if they have to go explain that, or their profit and loss is all their own money. So it's much different than the approaches that the banks and hedge funds take on potentially the other side.
We have about a minute left, and this is definitely a story that I know we're going to be hearing more reporting on from you. But regulators are watching Jane Street, specifically in India. Just give us the high level what the Securities and Exchange Board of India, SEBI, is looking at.
So they're looking at Jane Street's trading behavior, specifically in the options market. The regulator came out over July 4th weekend with an 105-page order outlining what they are alleging is market manipulation. And to not go too far into the weeds, but they're pointing out a few things. The size of the trades that this firm is putting on, and because of the size, the impact to the overall market. And they're claiming that Jane Street's behavior is ultimately harmful to the end investor. So this is playing out. The firm has denied that it is doing anything that is nefarious or would be considered market manipulation. So we'll see what happens next.
All right, Katherine Doherty, thank you for joining us right here in the studio this morning. She is Bloomberg Finance Reporter. You got to check out that article on the terminal.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.